Today, we're going to be looking at Chapter 2, Measuring Business Transactions, Objectives 3 and 4. During Objective 3, we will look at the double entry accounting system and look at the rules associated with double entry accounting. And in Objective 4, we will look at the transaction analysis and processing simple transactions. Is the basic method of accounting for all businesses. It originated or evolved during the Renaissance, and it was created by Father Luca Pacioli in Italy in 1494. It is based upon the principle of duality, meaning at least one debit and one credit for every transaction, and debits must equal credits for each transaction. Each transaction must be recorded and follow all the rules for debits and credits. We learned really these rules during the first semester, but we will reflect upon them and refresh our memories now. Again, every transaction has to have debits equaling credits. Accounts increase on their normal balance side and decrease on the opposite side. T accounts can be used by managers and accountants to help analyze transactions. And every transaction must have a source document to provide objective evidence that a transaction has occurred. We record all of our transactions in our journals. Journals are called the Book of Original Entry. They are recorded in chronological order as the transactions occur. Ledgers are where we maintain the balances of our accounts. We take the information from our journal and then transfer it to the ledgers where the balances for each type of account are maintained. In this way, through this double entry process and through our process of journalizing and posting, we can ensure that our whole system stays in balance. The T account provides a way for business managers to analyze transactions. Each T account records a title for that account and has a debit side and a credit side. The debit side is always on the left side of the T account and the credit side is always on the right side of the T account. They help us to analyze transactions. The T account can be looked at as an abbreviated form of the ledger for an account. It is a tool that accountants use to quickly analyze a transaction into its debit and credit parts. The ledger is the actual spot where the transactions are posted and recorded for balance purposes. A debit is commonly abbreviated as DR, and a credit is commonly abbreviated as CR. The debit, DR, is Latin for debrare. It does not mean that something is increasing or decreasing. That is all determined based on whether the normal side for that account is the left side or the right side. Credit is the Latin term for credere. And again, credit does not mean increase or decrease. It depends upon whether the account increases, again, on its left side or right side. So if an account increases on its right side, has a normal balance on its right side, then that account increases on its credit side, as opposed to an account whose normal balance side is on the debit side, in which case that account increases on its debit or left side. In this chart, this T account chart, we can see that this is the cash account. And the cash account has been affected by a series of transactions during a particular month. Certain transactions occurred that were on its left side, or the debit side, and certain transactions occurred on the right side, or the credit side. Those transactions on the left side for a cash account are increasing this account's balance, whereas those transactions that occurred on the right side, the credit side, are decreasing that account's balance, the cash account's balance. If we add up all of the transactions on the left side and subtract the total of the transactions on the right side, we see that our cash account has an ending balance of $15,300. So by footing or totaling each side, we can then take the difference between the debit side and the credit side to get the account's balance, whether it's a debit or a credit balance. This balance is the amount that would be maintained in the account's general ledger, in the general ledger for that account. We know that every transaction affects at least two accounts. We also know that the total of our debits must equal the total of our credits for each transaction. And we also know that our accounting equation after each transaction must remain in balance. So when we're done with entering the debits and the credits for a transaction, we know that the accounting equation, assets equals liabilities plus stockholders' equity, must stay in balance. If we look at the rules for our different types of accounts, assets, liabilities, and stockholders' equity, we see that assets increase on their debit side and decrease on their credit side. Liabilities increase on their credit side and decrease on their debit side. And stockholders' equity increases on its credit side and decreases on its debit side. Liabilities and stockholders' equity act in a similar fashion, meaning they both increase on their credit side or have normal balances on their credit side because they're on the right side of the big accounting equation, assets equals liabilities plus stockholders' equity. The process for analyzing transactions can be broken down into 5 distinct steps. First, we analyze the transactions to determine their effect on the accounting equation, assets equals liabilities plus stockholders' equity. We look at what accounts increased and or which accounts decreased. And this is supported by our source documents. We apply the rules for double entry accounting, determining which accounts are credited and which accounts are debited. And then we record a journal entry. When we record our journal entry, we make sure that we're entering our transactions in the journal in chronological order. We enter the date first, followed by the debit amount, the debit account, and then the debit amount. And then secondly, we enter the credit account and the credit amount. The credit account and amount are slightly indented. Often the journal form includes an explanation about the transaction. We did not do that during the first semester, but in many businesses, the journals leave space for a brief explanation about each transaction. After we have journalized a transaction, then we post that entry to the ledger accounts that were affected by that transaction. The ledger is where we maintain an ongoing balance for each account. When we post from the journal to the ledger, we transfer the date information and account and amount information for each transaction. Then, for each account, we record and update the account's balance. Lastly, we prepare a trial balance. The trial balance confirms the balance of the accounts. It confirms that the balances are in balance and that we've recorded all of our journal and posting. However, our trial balance does not tell us that we've done all of our transactions correctly. You can look at an example of the types of transactions we will be using for this semester on pages 101 through page 106 in your textbook. Our question for this section: why debits, which decrease owner's equity, increase expenses, which are a component of owner's equity? If you recall, this was a question that we discussed in quite a bit of detail during the first semester of this year. So let's look at the answer. Decreases in owner's equity are shown on the debit side. So, expenses which decrease owner's equity maintain a normal balance side of a debit because expenses always result in a decrease to the owner's equity or stockholder's equity of a business. So increases in expenses are shown as debits, which always decrease stockholders' equity. And that concludes Objectives 3 and 4 of Chapter 2, Measuring Business Transactions, for our financial accounting textbook. Please complete the concept review questions for Objectives 3 and 4 of Chapter 2 and submit your responses through Google. Please also maintain a copy of your questions and answers for discussion purposes in class. Thank you.